Good afternoon, UNH alumni. This is Jamie Shabbat. I am the Assistant Director of Career Resources and Programs in the Alumni Relations Office. This is one of a few of the webinars you have attended. Thank you so much. I know we have a few repeat people on here, and we love it, and I really truly appreciate all of the time that you've spent with us and taking advantage of some of the awesome and talented alumni that we have on these presentations. Today, we are going to be talking about a very important topic of planning for your retirement. We have alumni Scott Fitzgerald. He is the class of '97. He's actually the athletic director at Kearsarge Regional High School and a communications major when he was here at UNH. And he has a passion for this topic and has done immense research to be able to share with you why it is incredible to be able to understand this topic on your own. And tips and tricks to be able to effectively plan your retirement, even if you aren't a financial planner or someone who would consider themselves an expert in the field. We are thrilled to have him, especially coming from outside the financial industry. He has a unique ability to explain this in a very digestible way to make this webinar actionable for you. And with that, I'm going to introduce Scott. Thank you so much for being here.
Great, thanks so much for having me, and thanks to everybody for joining during the middle of the day. I know everybody's busy and appreciate you taking the time to be here. As was mentioned, not in the financial industry, but kind of had a passion through my own personal experiences, and then have a couple friends who have a background and expertise in it, and kind of really like the idea that something that seemed so foreign before was really something that with a little research and some effort cannot be such a scary topic, and one that you can actually kind of navigate the waters yourself in many cases. So kind of the points of emphasis we're going to go over today and try to keep things basic. I mean, first and foremost, not giving out advice here, not selling anything, nothing of that nature. This is simple information. This is a perspective through research I've done and through conversations I've had, and like I said, through personal experiences that I want to share and hopefully add to the pool of information that people have when they make decisions about investing. And if you're not investing, probably most importantly, to get you started, or some reasons why I think it would behoove you to start investing as early as possible. So we're going to go over some basics to kind of keep in mind when planning for retirement. Also, like I said, if you're not investing, there's reason to think about taking advantage of an investment matching benefit if you have it through your work, and why that's so important to take advantage of. Understanding different types of retirement accounts that are available, investing on your own versus hiring a financial planner, or strategies when using a financial planner to maybe save your money to use their expertise. Addressing some common myths and fears, and then we'll have some time at the end to answer some questions. So to start, some of the basics, I think one of the most important things, one of the most eye-opening things for me, and something to really understand, and that investing for your retirement is not a short-term proposition. This is a long-term endeavor. And you think about it, you think the word retirement, obviously that's not short-term. I'm 44 years old, or somebody around my age or younger, retirement is 20 plus years from now. So it's kind of easy in that context. When you talk investment, you see so much literature about 1 year, 5 year, beating the market 1 year, or 5 years, or 10 years, or even 15 years. If you're 25, this is a 40-year endeavor. So the thought or the mindset about investing for retirement has to be long-term. My wife the other day, the recent weeks, it's been a little crazy with the market, and she kind of asked, "Oh, did you see what the market did today?" Kind of in a tone of, how did that impact us? And I looked at her like, it doesn't matter. We're 20 plus years out from a retirement. So what happens today, or what goes on with the market today, is with that much time to go, it's simply irrelevant. And it's one of those exercises when you're investing in retirement for that long term. It's not good to watch it because of how volatile it can be. It can go up and down. Like today, 2 days ago it went way down. Yesterday it came back up. Today it's down a little bit because of fears about things going on with China. So it's something you can't predict. It's not wise to take that emotional roller coaster It's a very long-term proposition. The other thing I think in terms of investing, what we're going to be talking about has nothing to do with stock picking, nothing at all with trading and stock picking, because that, as we'll hopefully highlight, is a pretty futile endeavor. And I have a good friend of mine where I got a lot of the research. He's done a ton. Is Dr. David McLean. He's a professor of finance at Georgetown. We went to high school together, and he's done a lot of academic research. And he explained it to me in a great way that kind of made sense. He says, what makes it so hard to stock pick is essentially the stock market is always right. And what he means by that is if there's a stock worth $70 and it's selling for $50 a share, people are going to purchase that share because they feel like it's a value, and then will drive that price up and essentially set itself at an accurate price, or vice versa. If it's worth 50 and currently at 70, you're going to have a lot of people selling that, will drop the price and essentially correct itself. So when you're dealing with something that is constantly correcting itself, it's hard to make predictions on where that's going to go, or what are those outliers or unique scenarios where you can make money. And I put Netflix on here as well as Bitcoin as examples. Netflix, people will refer to it all the time because years and years ago it was really low price and it went up, and you hear of a few people who made money on that. This is not about that. This is not about that. There are 4,000 or 5,000 funds out there. You're not trying to find that 1 in 4,000 fund that will get you rich quick. That it's hard to do. And you even think about Bitcoin, same thing. Bitcoin's out there, and it talked about, oh, you can get rich, and if you invested early. The things with something like Bitcoin is there's no regulation. So Bitcoin, you could literally invest in it, and tomorrow your money could disappear. That's an investment that I think is crazy and not safe. And so I put that up there as an example. And Netflix, the other example is, say, a fund you can buy, you bought it at $5 a share, and today it's worth $800, let's say. When's the time that you sell? How do you predict that it was going to go up to 800? If it was at 5 and all of a sudden went to 50, in your $50 a share, you're in your mind going, well, great, I made 10 times my money here. Great time to sell, not knowing that it's going to go up another 750. So it's one of those things. It's so you can't predict. It's a futile effort. So this has nothing to do with stock picking. And then I put down in the bottom the 2016 S&P indices versus active fund scorecard. Essentially, that reviewed over a 15-year time period that active fund managers, hedge fund managers, things like that, people who actively trade, only 1 in 20 of them beat the market or outperform the S&P 500 over a 15-year period. And it gets even more difficult as time goes on. So we're going to be talking a lot about passive investment. Some more of the basics. When I speak of the market, there are two main ones that when you do research or you read or you hear about on TV or anything that you see. There's the S&P 500, which is the one I'm going to be using when I refer to the market. That's essentially the largest 500 largest companies on the market, and they take those 500, their performance, and that's kind of the indicator as how the quote unquote the market is doing. There's the other one you hear, the Dow Jones Industrial Average, or DJIA, or probably most commonly referred to as the Dow, which that one is 30 large companies. So some may consider that not as accurate as a 500 of them. Where some of the debate can come in, those are really large companies. So the market consists of small companies, large companies, medium-sized companies, international companies, things of those nature. So some people may say that doesn't give the whole picture, but that's been kind of shown to be one of the more accurate pictures when talking about the market, and that's the one I'm going to be using today when referring to the market. And also, like I said, we're going to talk about passive investing over the long run with minimal buying and selling, building slow and steady wealth, as opposed to active management or doing lots of trades or moving around funds a lot. Some more of the basics in terms of what we're going to talk about: index funds, and that's kind of the investing we're going to talk about, which are from a basic standpoint, large collection of stocks aimed at keeping costs low and lowering risk because of the broad diversity. Basically, they're built to mimic or track index. So like the S&P 500, that index fund is built to mimic the S&P 500. A dividend, which is basically a distribution of a portion of a company's earnings to the shareholder. So they'll announce that in percentages, what the return is, or for example, you get 50 cents a share for earnings in terms of every shareholder, for as many shares they have, they get 50 cents per share, and that is used. You can use that in income, but we're going to talk about it on how that you shouldn't take that as cash or income. We're going to talk about how all of those dividends should be reinvested back into your portfolio. And that we're also, when we talk performance of the S&P, that is under with the guise of reinvested dividends. Compounding interest, if there's two words I wish I learned about in high school or in college or any time when I was younger, would be compounding interest. I think it's something, as an educator, it's something that I'm going to be working on to try and get more high school students to learn about compounding interest, because I think it can be your best friend when it comes to investment. And I put there, unless you have credit card debt, it cannot be your friend where your interest can compound in a negative way. But in terms of investment, I think it's such a key component and we're going to discuss it a little bit today. And really, for everyone to understand, when we talk about the type passive investing in an index fund, it's all about minimizing risk. But I think everyone needs to understand that doesn't make this endeavor void of risk. Certainly there is risk involved when it comes to investment. There are no guarantees. We're going to talk about past performance of the market, but that doesn't guarantee, past performance does not guarantee future returns. So everyone kind of understanding that no matter what approach you take, even the most conservative approach, there is risk. And we're just trying to minimize that risk as much as possible with this approach. So reason to start investing or increasing your investment amount, if you're not investing now, I would implore you to start immediately and start as soon as possible. And in this slide, trying to give an example, because I hear a lot of times, especially with younger people, oh, I'm 25 years old, I'm 22 years old, I have time, let me settle myself more. Maybe I can wait till I'm 30 years old. It won't be that big of a deal. So if you look at the slide here, it says, going on the S&P 500 has over the past 90 years with reinvested dividends returned to sit just below 10%, but we'll call it 10% with an average annualized return. And we look at average annualized return. It's not an average return. For example, if you invested $10,000 and your money grew 100% in 1 year, you'd have $20,000, but then it lost 50% the next year, you'd be back down to $10,000. If you average those two, 100 with a negative 50, you have an average of 25%, which wouldn't be accurate because you're back down to the original $10,000. So the average annualized is more what the average return would be in terms of growth each year. So that's kind of what we're talking about there. So if you looked at, if you started with $25 per week at age 25 and invested that until you're 65 years old with a 10% return, you get a little over $630,000. And how you figure that out, there's a compounding interest calculator. If you haven't played with it online, you type it in online. It's an unbelievable tool, a fun tool. It may be the dorky side of me, but it's a fun tool to play with in terms of figuring out what potential returns are. So if you wait till you're 30, which you hear a lot of people, oh, I'll wait till I'm 30, I'm fine, that's not that big of a deal. Well, your return would only be $387,000, a little over $387,000. So you're losing out on over $245,000 in retirement, which is an incredible amount of money because of compounding interest. So a fun little exercise, what it would take to become a millionaire, and kind of try to highlight that to make it easy to see what that could be like. Again, assuming we have two return rates listed on below. But if you were to in year one at 25, so you're 25 years old, and you invest $1,300 or that $25 per week for a year to ease into it, be $1,300. Then for 2 years, you up that to $50 per week for $2,600, and then $4,200 per year from 28 to 30. And then at 30, one of the accounts we're going to be talking about, a retirement account, is a Roth IRA. It's a great account. That's my favorite account. The max you can invest up to 50 is $5,500 per year. And after 50, you can invest up to $6,500 a year. So if you max that out at 30, then max that out at 50, with a return rate of 7%, you get over $1 million. And why I put that return rate in there and says 7% for inflation, kind of what that means is what $1 million today is not, you wouldn't have the buying power 40 years from now with $1 million. So that's trying to account for, okay, $1 million today wouldn't be worth $1 million the same in 40 years. The other reason I put a 7% is that's kind of the general, and all the research or things I've read on a really safe approach to investing. 7% return rate is kind of a nice average people can use to count on. But then if you put the 10% return rate, which the market or the S&P 500 is return, you have over $2.2 million with investing what turns out to be really not a lot of money out of your paycheck. Taking advantage of company match. This, if you don't know if your company does it, you should research that immediately. And if your company does, it's something you should make sure in my opinion, should take advantage of. And here's why. You look at a $40,000 salary, for example, and your company matches up to 6%. So if you invest $2,400 yourself, and then they met, which is 6% of the salary, and they match that. So we talk about a return rate of 10% for the market. Your company is giving you a return rate of 100%. So you're outperforming the market exponentially right out of the gate with a guarantee match. So essentially, if you're not taking advantage of it, you're in essence kind of throwing free money away, which I would advise against. But if you look at those, if you invest up to 6%, $4,800 a year for the 4 years at 10%, $2.3 million. And that's if your salary never goes up, which we all know it will. So that's kind of some simple math to show what that can do for you if taking advantage of the match. Another reason so if you have a match that traditionally goes into a 401k, 403b, I'm sure most of you, if not all of you, have heard of those type of retirement accounts, which are pre-tax dollars, meaning they take that money out of your check before you take out taxes. And I haven't found anything on the Roth IRA is post-tax, and we'll get into that. And I haven't found in terms of math that there's a huge difference in terms of the end result if you take it out before or after. I'd love somebody to do all that research and crunch the numbers over a 40-year period. But essentially, it seems like it's more choice than anything. But one of the advantages, if you take that money out, and let's say you're on the threshold of a tax bracket, which, say you're on the 38, I think it's about $38,000, or maybe it's somewhere around there. So let's say it's $38,000. If you pull out $2,400, then all of a sudden you're $37,600 on your salary, and you drop a tax bracket. So if you did that, it wouldn't be $100 out of your check take home. It'd only be $88, and you would realize a savings of $298 with that lower tax bracket. And essentially $2,400 would only cost $1,814 in actual cash now, or $151 a month. So that can help you if you need some leeway there, that, okay, you lower your taxable income, you get some benefits there. You also, it's not $100, it's actually $88, which you'll be taxed as income in retirement, but it's a way to save some money now if that's what position you're in. So the different types of accounts we talked about, the 401k, 403b, and those are pre-tax dollars, as we talked about. And the thing is, check on the match A, but also if you're in a 401k or 403b plan, look to see what funds you are in and who they're with. And we'll talk about that in a little bit, because there are fees associated with the index funds. Some are much higher than others, so you could be losing out on some money there if you're say you're getting charged an extra 1% in fees because of the account you're in. So that's something to research, and we'll get into that a little bit later. And the Roth IRA, which I think is a phenomenal account, ideally you can do both, which is post-tax dollars that's going to come directly from your bank account. And because you've already been taxed on that money, all the gains are tax-free. And one of the coolest parts, I think, is that you can use that for college expenses for your dependents or your children. So you can, and that's penalty-free. So you can use that account to not only save for your retirement, but save as a college fund. So say if your child decides to not go to college, or you got great financial aid and you didn't use a lot of that money, all that money goes to your retirement. There are some restrictions in terms of a Roth IRA, in terms of the income you make, because the Roth IRA has to be earned income. So say even if you're 18 years old and you want to start investing, which would be tremendous if you have a son 16, a daughter 16, and they want to start investing, which would be tremendous. The money that goes into that has to be earned income. So they would have to have some sort of employment and show that they, say, earned $1,000 that year and invested $1,000. But the cap on that's $120,000 if you file as single individual, or $189,000 if you file jointly as being married. But again, that's a tremendous account that I would highly recommend, and again, would take any questions on that at the end. So as we look into why we're talking about passive versus any other type of investment, and Warren Buffett, if you look up, if you don't know that name, he Berkshire Hathaway created that company. He considered by most people to be probably the best investor of all time, or one of the investors of all time. And I put this quote up there from him to kind of show why I think passive investing is the way to go. And he says, making money on the stock market does not require great intelligence, a degree in economics, or familiarity with Wall Street jargon. What investors then need instead is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. Stick with big, easy decisions and eschew activity. And I had to look up what eschew means on my own, and that means avoid activity. So essentially, that's why it spoke so much to me and have gained a passion. I don't have great intelligence or a degree in economic or familiarity with Wall Street. But when I kind of learned that I didn't have to have all those, and what it means by disregard mob fears or enthusiasms, meaning mob fears saying, oh, if we bury the money in the backyard because if you invest it, you could lose it all, which is not necessarily true. Or enthusiasms going back to Netflix and Bitcoin, the make the fast money type enthusiasms. If you avoid those, stick to simple fundamentals and stick to easy decisions where you don't have a lot of activity. And that kind of goes back to the philosophy of passive investing versus active management. So investing on your own and avoiding unnecessary fees. I think this is what's been a nice eye-opening piece for me, is that I can avoid a lot of unnecessary fees, and I'll show you how much that can actually be. So many agree that the goal of a long-term efficient investor is to be diversified. That there are large cap funds, large companies, mid cap or middle-sized companies, small companies, international companies, growth stocks that look to like a Netflix, that tremendous growth, or value stocks like an AT&T, very stable company that's going to pay, not necessarily go up and down as much in terms of the price per share, but they're going to pay a really good dividend. So you can get good income that you can reinvest in a nice value type stock, as well as some bonds, which are considered the safest type of investment, because in many ways that return is kind of guaranteed to you, with not 100% guaranteed, but it's the safest because of the way it's structured. And how do I feel you accomplish that on your own? In my opinion, target retirement index funds, I think, are the best way to go, and we'll explain that. So here, if you look at, say you're 30 years old, and the target retirement funds, what those are is the target date is for basically when you think sometime around when you are going to retire. And what that puts it in is try to put your money in the safest position when you retire, because you don't want a lot of ups and downs. You want to kind of build that portfolio up and be at a point where you can rely on not a lot of fluctuation. Like I said, not a lot of up and down, small in terms of how much the money goes up and down, but you're able to then draw that money out, and that's your retirement income. So if you look at the 2050, if you're 30, in about 32 years, you'll be somewhere around 62 years old. So that's kind of a good target date to pick. And what does that fund look like? Well, there's first the total stock market index fund, which is a little over half of what you would own. That essentially is you own every share out there. You cannot be more diversified because you own everything or a piece of everything. It also has some international stock, a small amount of bonds because you have a lot of time to invest. So you can be a little more risky with your money. It doesn't have to be in as safe position. You can try and take advantage of some larger growth. The expense ratio, which is kind of a fee inside the fund, why it's so low, because it's passive investing. There's not a lot of management going on, or almost none, so they don't have to employ a lot of people to do a lot because there's not a lot going on. And so that fee is a real small at 0.15%, and it shifts as you near the target date. So if someone were in the 2015 target date and in retirement now, it'd be 58% bonds and 42% stocks, or sometimes people refer to them as equities. So you'd have more than half your portfolio in nice safe things, and less than half in where you can maybe get a little growth and they can kind of put you in a good safe position. And if you want to go about setting this up, Vanguard, and this is the one I use. I don't work for Vanguard. I haven't talked to anyone from Vanguard in terms of this presentation or anything I do with this. It's the one I use. It was very easy. They walk you through it. It's a $1,000 minimum to purchase the fund, the target retirement fund. However, I have some people here at work that they didn't have the $1,000, so they're just putting in $50 a month, let's say. And when it's put into basically what's a money market account, which is essentially a savings account. And when you reach $1,000, you purchase the fund, and then all subsequent investments or transfers of money, you purchase those funds. But again, any questions afterwards, certainly be happy to answer those. So avoiding unnecessary fees and lots of money. This was the scenario I was in personally before I switched to Vanguard and took advantage of the low fees. What you see there on the screen, it's not all of them. I was basically in a dozen funds, and these were all good funds, very diversified. There's large cap in there, there's mid cap, there's small cap, there's international, there's bond. It's all in there, but what I list there are the expense ratios. So in mine, in the 2040 target retirement fund, which I have, the expense is only 0.15%. If you look on there, what's next to all those funds, much higher. So let's say a little over, essentially an additional 1% in fees that I'm paying. And then I was also paying a management fee for the money to be managed. But essentially what was done when I had that happen is someone put me in those dozen funds and they just kind of stayed there. There was very little, which is what should be happening. There shouldn't be, as we saw Warren Buffett say, there shouldn't be a lot of movement. You shouldn't be predicting funds, as we saw. That type of, the evidence is overwhelming that active management cannot beat the market. And so that I was paying a management fee to manage the money, though there wasn't really much managing going on, which was a good thing, but it's a bad thing that I was getting charged for it. So essentially I was kind of paying 2.25% more than I am currently with Vanguard. So what does that look like? It doesn't sound like much. Oh, 2.25%. If I have $1,000, it's $2,250. That doesn't sound so bad. But if you look at it, so the 10% number that we kind of brought up with 2.6 million, if you invested $5,500 for 35 years at a 10% return rate, a little over 2.6 million. If it goes down to 9, you lose $652,000, a little over that, so if you're taking a salary, say you're 65 and you live to 85, you have 20 years of taking a retirement salary, you're losing out on $32,000, a little over 32.6 per year for those 20 years. If you go down 1.5%, you lose almost $1 million. You go down 2%, you over 35 years, potentially losing over $1 million and almost $57,000 a year salary. I know for me in education, never making a ton of money, so $56,000 a year is massive, and there's compounding interest working either for you or against you. And if you look at it, kind of, okay, that initial $1,000 investment at 1.25% management fee. Say the fund fees are the same and you're just paying that management fee. Well, that's $12.50. Can be considered a small fee. Well, for 40 years at 10%, that's $6,085.65. Again, not a ton, but that's just 1 year. Add that together for 40 years, as well as compounding what you're losing. Okay, you lose the $12.50 that year, but then you're losing that ability for that $12.50 to make money for you over 40 years. You add that all together, and in this case, over 35 years, you add that all together, that can result, as you can see, in a lot of money that you can save yourself by taking a very passive approach with no management. And kind of like I said, the evidence would suggest that's a good way to go. So if you're going to go with a financial advisor, which I know many financial advisors who do a great job, who are well-informed, who don't take the approach I received, and so that can be a good option, but I think the goal of this is to give you an informed decision. I look at it, you can build a deck. I could figure out how to build a deck on my own, but it's up to me whether I think it's worth to pay that money, to pay an expert to do that, or try and do it myself. Or like a funny example is the playground. My kids are 8 and 6 and put a playground together, and I'm sure many of you have, and I paid the extra, I think it was $100 and something to have them put together. And I watched someone who was an expert and done this a million times take 8 hours to put it together. That was worth every penny. And if they had advertised that scenario of taking 8 hours as an expert, I would have paid 3, 4, 5 times that to put it together. So again, all personal choice on how you want to spend your money, but just trying to give you information so you can make the most informed choice. So I would suggest when you're going with a financial advisor, maybe looking at paying a one-time consultant fee to get you started. If you're nervous about, maybe you don't want to go in just a simple target retirement fund and you want someone to help set you up, I think it's a very reasonable ask. Okay, pay a one-time fee. So say it's $100 an hour. So you can go for an hour or 2 hours, get a consultation, get some guidance on how to set you up. You can leave those funds there, and then maybe even pay for check-ins. Say you want to check in once a year, you want to check in once every couple years. I think that's great because you get some good guidance. You have fears when it comes to your money, so you can pay a well worth fee or a valuable fee to get that great advice. I put 1.1% of 2.6 million. Where it really gets, what you got to understand is, so say you get to 2.6 million by the time you want to retire. Well, 1% is that you're paying $26,000 annually for basically distributions you're getting. That's a lot of money to me personally to pay for what's not going to be a lot of activity, so that you have to decide on your own. So that's kind of just a highlighting to understand that amount of money. What can be good, the one I went through was only financial advisors, but there are many companies that provide life insurance, that provide guidance in terms of wills, taxes, trust funds, all of those things. So if you get somebody that offers a really great complete package beyond just financial advice, which in many cases you don't really need, but all those other things I know personally I'm going to need those. So trying to figure out what that value is or what that's worth to you in terms of what you're getting for your money. And I think if you're sitting down with an advisor, so I think a fair question to ask, and this may stir the pot a little bit, but I would ask them what their annualized return of their personal portfolio over the past 20 years. And with the fee added in, how does that compare to the market? An S&P 500 index, or if you want to say, compare it to a target retirement fund, and have them give you 20 years of data in comparison. Now, what might be tough is if you get a new financial advisor, they can't do that. But I think that's a valuable question because, as we talked about before, this isn't a 1 year, a 5 year, a 10-year endeavor. This is ideally, if you get started early, it's a 40-year endeavor. So long-term data is key, and adding in that fee is paramount. Another question to ask is, do they have relationships with vendors where they receive compensation for putting clients in their products? So are they steering you towards products where they receive kickbacks or they receive money for making those sales? And as a fiduciary, there's a designation of the fiduciary law. Unfortunately, that law is kind of up in the air right now. It was brought in, but now they're discussing maybe not having it anymore. But that fiduciary law essentially says you have to put your client's best interest at the forefront. You cannot make decisions based off of any self-gain. It has to be all on what's in your client's best interest. So that's a good safeguard against someone steering you in directions that may be self-motivated. And I think it's also talk about the fee structure and if they would be willing to only collect a fee if they outperform the market. Now, that can be on the downside too. If the market goes down 20% and they manage your fund to get it down only 15%, okay, they saved you a good amount of money there. Talking about a fee setup that maybe factors in their performance. And I wouldn't say, I've seen some people say, well, you will only collect a fee if you make money. Well, over the 90s, let's use the S&P index. Over any 25-year period of the S&P index, it hasn't gained less than 9.15%. It's gained money over every 25-year period. So the market essentially gains money. So saying we'll only collect a fee if we make money, you could do simply nothing but invest in an S&P 500 and you're going to make money. So I think outperforming the market, using that as a benchmark, is a good discussion to have. So common fears or questions. Target retirement fund versus an S&P index fund. This is where I think where you get into maybe, I would say a target retirement fund is a really safe way to go. It's long-term. It has some bonds in there. It has international, so you're even more diversified than an S&P, so it's very safe. That could cause it to not perform at that 9.8% level or 10% level. That could bring it down a little bit, but that's certainly a safe way to go. The S&P 500 index, which again, I said over a 25-year period, the S&P has never lost money and actually gained significant money on an annualized return, average annualized return. The hard part about that is when do you pick to make the switch, if you do, to a safer account? So say, what age I invest at 25 in an S&P index and go for, what's the age where you start to put that money in a safe spot? Because in retirement, depending on your risk tolerance, you may not want to have that money going up and down. You just, okay, I built this wealth up. I want it super safe. I want to keep it there, and I want to be able to rely on it as income. So you'd have to switch it out of an S&P 500 index. So that's the tough part. When do you do that? How do you go about doing that? The target retirement funds, that's gradual over time. It gets you into the position where it is much safer when you do retire. And so that's kind of up to you in terms of your risk tolerance, what the options are. And I think that's where an advisor can come into play as you get towards the end of your short retirement, is what are their thoughts on how to approach that? And again, I would approach it as not 1%, because if you're at 2.6 million, that's $26,000 a year you're paying. Maybe what's a consultant fee or a consultation fee or an hourly fee that you can pay them to talk about, okay, I'm looking to make the move into some safe stuff. What are your thoughts? How do you think I should go about that? I think there's great value there. What happens when the market goes down? I think that's a big fear, and I talked about that. Do you see what the market did today? Well, it doesn't matter. And in terms of now, when there's so much time, one of the great things, if you think about it, so if 2008, the market went way down. There was the dot-com crash in the early 2000s, and then there was kind of that real estate mortgage crash right around 2008. The market went down almost 40%. A lot of people panicked. A lot of people sold money. Well, you don't realize any losses or gains until you sell it. So you say, okay, my account's worth $100,000 now, and okay, the market goes way up this year. Now it's worth $125,000. Well, it really is only worth what it's worth when you decide to start selling funds. So if you look at it like that, so okay, say you have 1,000 shares at $100 a share, so you have $100,000 prior to 2008. Well, when it dips down, when you're in, say me, for example, I have 22, maybe 21 years left, I now get to buy those funds as a discount as it goes down. So in 2008, I get to buy it at $90 a share, $80 a share, $70 a share, even close to $60 a share, and then buy it on the way back up. So now I got a discount or a coupon on my shares, gathered all these shares at a lower price. So then a few years later, when the market came back up, I was in a much better position, because since then it's gone up. It's done tremendous growth. So I went from my 1,000 shares at $100 a share to what's called dollar cost averaging, which I was able to then drop the average price of my share down below $100. So I gained more share. I lowered the average price, and then I was in a better position to take advantage of the growth, after 2009, 2010, when it started to go up. So in a lot of ways, if it goes down, great. Now I got a coupon. It's like things going on sale. Another fear, I think, or I hear, can I lose all my money? Being in such a diversified option, I would say, if you own the index fund that's a total market. In reality, this is kind of a basic ingest example, but in reality, the planet would have to blow up for you to lose your money, because you own every share. The stock market would have to collapse and disappear. The odds of that happening, I guess, are not impossible, but are pretty darn low. If you buy an individual stock, or you rely on, okay, I bought all my money in Radio Shack, for example. If Radio Shack goes out of business, you could lose all your money. So that's why this very diversified approach, that's what, when you hear people or advisors or read articles about being diversified, that spreads your money out over wide ranges of funds, so that you're really putting yourself in a good, safe position. I also hear, who's managing my money if I go with a company like Vanguard? Well, nobody really. And that's the whole point of it. When you get to put yourself in those index funds, there's not a lot of management. It's almost kind of like a bank. You invest in the bank, you put the money in there, they execute the transactions. When you invest $400 a month in investing, they will purchase those funds for you. They will execute those transactions, but no one's managing your money, and that's a good thing, because as we've seen in the managing piece, active versus passive, no one can beat the market in terms of trying to actively manage the money, in my opinion. And so when you passively invest, passive investing, no one's managing it, and that's a good thing. And that's why you pay so small of a price on fees. What if I can't afford to start investing now? If you saw, we can go back to that slide earlier about the difference. So, over $240,000. If you wait 5 years, boy, it's pretty worth maybe picking up an extra waiter or waitressing shift, a bartending shift, changing your phone plan so you get $25 a week less, changing your cable, not having cable TV, not having the most expensive phone plan, whatever it is, to get $25 a week, not going out to dinner. I think it's so worth it because of compounding interest, that the earlier you start, the more it can compound And then as it compounds and gets bigger, then 10% on $1 million, obviously is a lot more than 10% on $1,000. And the earlier you start, the better. So finding ways to just get a small amount of money to get going, I don't think you can afford not to. And I wish somebody had told me when I was young, do this now and talk to me about compounding interest. And the last one, this isn't about becoming rich. I'm an educator, I'm a coach. I take an approach on this, on giving information, on trying to support and be helpful. I'll never be rich being an educator, but I love my job and I'm very happy. So this is more about not having money be a stress when you get to the point of retirement. Money can't buy you happiness. I truly believe in that. But, if you have a little more, it can buy you some time. If you're a grandparent and you have the funds to now take 3 or 4 more trips a year, that's 3 or 4 more trips with your kids and your grandkids. That would make me very happy. It's not having, okay, the bills come in, and if you supplement your retirement income a little more, it's, okay, now I don't have to stress about this, or I can live in an area where I really want to live that's a little more expensive. That would make us really happy, and by taking a few small steps, I think you can accomplish that. So again, I appreciate everyone being here, and this is kind of a thought, an approach, and information to consider when you're looking at your own personal investments, or if you're not investing, man, hopefully it's that kind of proverbial kick in the old rear end to get you going, because it's worth it, and you can really get yourself going if you start now. So again, thanks so much, and I will we'll open it up to any questions people may have. It's a lot of info in a small period.
Thank you. This is Jamie again. I'm just hopping in to explain the Q&A process. So Scott, this was incredible information. I'm sure there's a lot of questions. I know we already actually have a few. If you have questions on the line, there's a Q&A function. If you look at the bottom screen, there's you'll see the number of participants, and then there's Q&A. Please pop your Q&A questions right in there, and then Scott will be able to read them. I do want to mention too that I think that we just got a question in the chat feature. So Scott, do you see that there?
So, okay, Q&A.
There's Q&A, there's one question there, and there's another question in the chat. So the question in the chat says, when should I get out of the market? I'm 70 years old. The market is making me very nervous. Presently, I plan to sell half now and half next year. So that's the chat question.
Yeah, and that's a great question, and one I think about a lot, because of what's the strategy. You hear both sides on if it's doing really well like it has done the past decade, am I losing out on growth? And I think it's a comfortability question that obviously now it's doing pretty good, and if that money or that question is making you super anxious right now, I think not a bad time to get out. But this is also a good time where you can pay a consultation fee to a fund man, a financial planner, that you can pay a small amount, which they can kind of walk through that whole process, answer a lot of questions. But if it's stressing you out, not a bad time, I think, to get out. If you're looking for more growth, you can keep some in there, but kind of dependent on that position you're in. But this is a good time to talk advice. But a great question. That's one of those hard questions, because the market's so unpredictable and no one can predict it. So when's a good time? Could now be a time, or does it grow more? So if it's stressing you out, that might be a really good tell for you to start taking those steps. I have some other questions. How do the fee expense ratios on a target retirement fund compare to the fee on a standard index fund like an S&P? They're very similar. Depending on the companies you go towards, you see, I think Fidelity just came out with some index funds that are really low fees. So they're very similar. So that's what's good. It goes back to what your risk tolerance is and how do you want to approach that. But luckily, those fees are very similar, and a number of companies offer those index fees or index funds at very low fees, and you don't have to pay that management fee. It's something you can do on your own. For our Roth IRA, can interest income be used for college expenses for kids, or is it only the principal that can be withdrawn? No, that money in that account can be used for college expenses. So that's what's great about that account. There's in financial aid professional can be a little more adept at this, but you have to, when you withdraw that, it'll look like income for your child, but you can file paperwork when it comes to financial aid that will show that that's not necessarily income, so it won't impact that financial aid. But yeah, you can use, that's what's great about it. You can use that money for those college expenses, and all the growth is tax-free because you already paid taxes on it. Great way to save for it. Can you talk about a Roth 401k offered by a company that includes an employer match? I understand there are differences between a Roth IRA and employee-sponsored Roth 401k. Is employer-sponsored Roth 401k a good option? I would talk to your HR and talk to them about that. Any sort of match, to be honest, I think is something you have to take advantage of. You may not have to maximize it or put all your investments into that vehicle. So you can get your own Roth IRA and take advantage of a company-sponsored match. But any match, like, you're gaining 100% of your money. It's free money. So really talk to them about what that looks like. Your HR person should be able to talk to you about that. And that's, again, you can talk to either an accountant or a financial professional on a kind of that fee basis where that would be. But again, it's that free money that I think is so important to take advantage of.
I just saw, who I'm scooting over, it looks like we have a couple or another one that came through the chat. Do you see the chat down below? It says, if you are limited to input $5,500 per year, does that include the initial investment? Also, is that per person or per couple?
Great question. Yeah, excellent question. So that 5,500 is the limit in total. So 5,500 total, but it's a great question. If you're married, so my wife and I, we get to each contribute $5,500. So you can, as a couple, contribute $11,000 to a Roth IRA. They're in separate names, so one's in my name, one's in her name. But as a couple, if you stay married, that's your money collectively. So you have the power to invest $11,000 a year in that account, which is awesome. I mean, we just started doing that when I came out of my situation and switched over. We started doing that $11,000 per year. And it's great. It took a little bit to kind of get used to, where you're looking, 5,500, I don't have the exact math. I want to say it's about 455 to 460 per month. So you look at it, say $900 a month as a couple. Initially, that takes some getting used to, but I'll tell you what, we're well into it now, and I don't even know it's missing. So it takes a few months to transition, but once you get going and get used to it, it's so well worth it. I'm not seeing the chat part.
Okay, I can read it to you. It says, question is, I work for a large company that utilizes Fidelity for our fund manager. Do I pay fund fees, or are they waived as my company is so large? How do I find out my fund fee?
That's great. That's a great question. So any company you have, you'll have the ability to log into that website. So you can go to Fidelity. If you don't have login info, but they can get you login info, and you can look at your own account. So when you go through online, like for example, when I was in my situation, I had previously, they went through Schwab. So I went on the Schwab account, I had a login info, I could look up exactly what I was in. So when you can go on Fidelity, look at what funds you're in and what they're called expense ratios. That's the fee that you're paying to own that fund. So I don't believe you're paying a fee in terms of a fund, in terms of a management fee or a financial planner fee, because it's through your work. But I double check with HR. But yeah, go right online, look those up and then start comparing, because you can choose now, like Fidelity has what I believe is called a Freedom Fund, which is kind of their version of the Target Retirement Fund. They also have a really low cost S&P 500 fund, I believe. But they have some really good index fund options that are very inexpensive. And so if you, again, you could be losing out, you go back to that graph, you could be losing out on 1% a year because you're paying those fees while you're in a nice diversified portfolio, in a good portfolio. You could lose out on 1% that you don't even know. And what's so tough about those expense ratios and those fees, they're really hard to find. They don't necessarily pop up on your statement. So they're really hard to find. You got to do some serious digging to find those. That's not because they're trying to hide them or anything. That's just the way it's structured. It's part of the fee structure. So there's nothing bad going on there. It's just, that's what's tough about those, is you don't necessarily see them unless you really go look for them. So go online, find out what funds you're in, and you can look up those expense ratios. I think that will be very helpful.
Awesome. We had one question that I answered in text, but I just want to make sure everyone knows I will be sharing the slide deck after the presentation. We also do record these. It takes us a minute to cut the recording and get it up on the website, but we will have that available as well within a week or so. So you will have that. And then if anyone has any other questions, feel free to jump in real quick.
Yeah, I see one more. It says, I'm contributing to a 403B through my job, awesome, plus a small amount to a Roth IRA, awesome. I also have student loans, car payments, and a mortgage. I know that. It's tempting to want to make extra payments towards these loans, but I'm wondering if you could speak to whether it's worth doing, or is it better put any extra funds that I might have into one of my retirement accounts. That's where you can try and do a little math. So what's the interest rate on your loan? That's where the extra money comes out. So a lot of the discussion, you'll see articles about, should I pay off my mortgage, let's say, and start investing that money. And that, you know, that's that battle that people look at. So if your college loans, let's say you're paying 4% interest on your college loan, and if you do an S&P and you can maybe gain, you know, that 9.8%, again, it's not guaranteed, but let's say you gain that 10%, instead of paying that, you gain 6% there in terms of investing and gaining, you know, getting 10% growth versus paying that 4% interest rate off. So you have those loans. So it's kind of look at what's your interest rate, what type of funds you want to go in. So it's really trying to do some math. That's a tough part. A lot of those conversations are, what do you do with the extra money? So like, for example, for me, I'm kind of trying to look at, now I have a 15-year mortgage that's about 9 years left. Like, you get a great tax benefit on the interest you pay on your mortgages. And I'm maxing out my Roth IRA. We don't have a contribution for 403Bs. I put some money in there, but I'm not getting that match, so I'm not necessarily gaining things. So if I'm maxing out my contribution, I'm looking at it, it's like, okay, I can pay this, my loans off, or my mortgage off, save some money on that interest where I'm not paying so much on the interest. I really tack down the principal, and then can take some of that extra money to invest on top of it. But really, if the goal is to try to max out that Roth IRA as soon as possible, because theoretically, based on historicals, again, there's no guarantee moving forward, if that 10% rate holds up, it's worth gaining 10% than paying only 4%, because you'll have an extra 6% there. And don't hesitate to shoot me an email, and we can even set up a time for phone call. Again, I'm not an expert in this. Like I said, I don't work in the financial, I didn't major it, just done a lot of research and try to take an approach of simplifying things. And again, just giving people information so you can make those choices that work for you, you know, in terms of what you want to pay and your risk tolerances and how you want to approach investing. It's a cool thing to look at, and it's fun. I really enjoy looking at it. So I have no problem if you have questions, shoot me an email, and I'll try and help out any way I can, or even try and steer you in a direction that someone may have better knowledge than I do.
Awesome. And this is Jamie again. Thank you so much. You're very timely too. We're at 1 o'clock right on the dot. I'm super impressed. Thank you for all of your time and all of your knowledge, Scott. This was awesome. And everyone, if you have questions, definitely feel free to either follow up with Scott or follow up with me after. I will happily facilitate that. We did just launch our poll. We would love your feedback. This webinar series is new for us here in Alumni Relations. So we're doing our best to offer the best programming we can for you to make sure you keep getting the most out of these. So we really appreciate the feedback whenever possible. So if you wouldn't mind filling that out before you jump off, that would be great. Otherwise, thank you so much. Enjoy the rest of your week.
Thanks, everybody.